Hey everyone, welcome to another video on strategy series of Short Straddle. Previously, we have made 3 videos. In the first video, we gave a different perspective to Short Straddle. In the second video, we discussed about exits. So exits are one of the most important thing. And then we also discussed about position sizing and risk management. And then in the third video, we also discussed about position sizing and risk management. And now finally, we are moving into the most important part, which is trade management. So in this trade management, we'll be looking at adjustments and how exactly you can adjust your short straddle trades when it starts to go wrong. So this entire video will be covered in 4 different aspects. In the first aspect, we'll be discussing about why it is important to adjust the trade. In the second aspect, we'll be discussing when exactly we should adjust the trade. And in the third aspect, we'll be discussing on how to adjust the trade. And finally, in the fourth aspect, we'll try to combine whatever we have learned in the previous video plus whatever we are learning in this video, combine everything and see how we can apply it practically. So this is going to be more of a practical session. So we'll be simulating a lot of things and trying to understand how we can create a short straddle and also end up managing the entire trade. And finally, the most important part, that is exiting the trade. So there are many ways to adjust a short straddle. It can be either averaging, it can be shifting and martingale. So in different kinds of adjustment, there is different risk exposure. So if you end up averaging, you will add on extra quantity, thereby increasing your risk. So in this particular video, we will try to focus on adjusting short straddle in this simplest way, which is nothing but shifting. So shifting more or less refers to cutting a leg and adding another leg. So as we move in the video, we'll try to explore what are the advantages of shifting and how exactly it can be done in a practical trade. This video is pretty lengthy because we are covering so many different aspects, and that's the reason I recommend you to play this video at 1.5x. Now let's quickly get onto the screen recording where we'll start to explore the concept of trade management of short straddle. Hey everyone, welcome to the video, and in this video we are going to learn about trade management. And whenever we say trade management, we refer to adjustments because it is quite natural for us that the trade after we enter starts to go wrong. So let's say we enter a range bound trade, the market suddenly starts to become very violent. Or let's say we enter a bullish trade, the market might start to crash. Because of which we have to continuously keep monitoring and also manage the trades whenever necessary. Whenever you say adjustments, people usually think adjustments are very complicated because any video you open, everybody teaches a different kind of adjustments. There are so many different kind of adjustments. That is what actually makes you feel complicated and really wonder how should I really adjust the trade. So now we'll be discussing a very simple framework to simplify this entire concept of adjustment. So now we'll be discussing a very simple framework to simplify this concept of adjustment. And whenever I talk about adjustment, in this video I am referring to adjustment of short straddles. So I'll make further videos in the upcoming days to learn how to adjust a short strangle trade or maybe something like a bull call spread or even intraday trades. So we'll be having a separate series on that, and this particular video will be covering only adjusting a short straddle. And once we go to the adjustment framework, first we'll start by discussing why exactly you should adjust a trade. What is the main reason or the primary reason to adjust a trade? Then we'll move on to learn when to adjust a trade. So there might be multiple situations when you might not even have to adjust a trade, and there might be some situations where a trade adjustment is required. So we'll be discussing more on that. Then we'll move on to the part of how to adjust the trade. So there are multiple ways how you can adjust a simple short straddle. So there are things called as average, shifting, martingale, and so many things. But let's try to simplify and stick to only one way of adjusting the trade, which I'll tell you as we move on in this video. This video can be slightly lengthy because we are covering so many aspects. So first, let's quickly start off by looking at why we should adjust the trade. So whenever we have to discuss on why we should adjust a trade, there is only one main reason, that is nothing but to increase the probability and the range. So what exactly do I mean by increase the probability and the range? For this, let's quickly open Stockmock, and using the simulator, I'll explain what exactly I mean. I've also attached a separate link in the description by which you can open a Stockmock account and get some exciting offers. So here I have opened Stockmock simulator, and let's select a random day. Let's say 19th of May, which is a Friday. And we will also select or end up doing a short straddle at 43,900, right? So once I do a short straddle at 43,900, you do see that you have profit probability of 57%, and also you have this particular range. So this short straddle is covering a range of close to around 1100 points. So now let us just move ahead by 2 hours. So once you do that, you can see that now the market has slightly moved lower, and the chances of the market going lower is much higher. So all you can do is simply cut your put leg. So before I cut my put leg, what I want you to note is the break even, which is 43,312, right? So now I'll just cut my put leg and short another put leg at 43,200. So once I do that, you can see two things which happens. One, my break even is now completely shifted down. Previously, my break even was at 43,300, and now you can see my break even has moved by 400 points away, increasing my probability of profit also. So this is one main reason why you have to do the adjustment, because in case if you're going wrong, you can simply widen the range and increase your probability. So now coming to the second reason on why to adjust is simply to have a better trading performance. So what exactly do I mean when I say have a better trading performance? The thing is, whenever you go wrong with short straddle, it can lead to very big losses. So you might have a loss of 3%, 5%, and so on, right? So you can reduce the losses by adjusting your trade. Now, let us say you can make a profit of 25% per annum with a drawdown of 5%, or you can make a return of 35% per annum with a drawdown of 15%. So, which one are you more likely to choose? So, will you choose 25% with a 5% drawdown or 35% with a 15% drawdown? Most of us would likely choose this particular option where we make 25% with 5% drawdown because it is more consistent. And when you adjust the trade, even though your returns are going to get lesser, your drawdowns are also going to reduce. And that's one main reason why you can try to optimize your performance by adjustments. So maybe if you don't adjust, your returns can be slightly better. But the thing is, on the other hand, when things don't go well, your drawdowns will also be quite high. But with adjustment, even though you reduce your return by a small margin, your drawdowns can be reduced to a greater extent. So these two are one of the main reasons why people usually adjust the trade. Since we know why exactly we have to adjust the trade, now let's quickly move on to when to adjust the trades. Before which, I would also ask you to go and check out quickalpha.in. So this is a new company where we offer different kind of services. So make sure you check that out. So now we come to the second important aspect, that is when we should adjust the trade. So whenever we talk about when to adjust the trade, so I would like to put this entire thing into two main points. One, you can adjust the trade when a major support or resistance is broken, or when there is imbalance in premium. So I particularly end up adjusting the trade only because of these two reasons. So there might be n number of reasons why you can adjust a trade, but for me these two are the main reasons when I end up adjusting the trade. I'll be explaining this using the help of a practical example, and first let's start with support and resistance. So right over here I have opened the Bank Nifty chart on TradingView, and right now we are at 21st of April, where I will start to simulate the chart. Let us assume we are starting the trade on 21st of April around 9:15, and right over here I have marked the important levels of support and resistance. So assuming that we are right now at this particular point and we have to mark important support and resistance. So this would be one very important resistance and this would be an important support which I would be marking, right? So looking at this, let us say I ended up doing a 42-200 short straddle. So that is right over here. I'll create a 42-200 short straddle in the morning. So our first criteria is whenever a major support or resistance is breached, we can end up adjusting the trade. So now just have a look at the break evens. The break even is 41,636, which is below the support which I have marked. So that is right over here. It is below the support. And when you look at the resistance, that is 42,763. And this is much above the resistance what I have marked. So many people only end up adjusting once the break even is breached. I am not a real big fan of that kind of adjustment. So there is nothing wrong with that, but I do not like to hold any particular trade so long when it is going against my view, right? So I don't have to wait till the break even when I know any major support or resistance is broken. And because the support and resistance is beyond my break even, I prefer doing the short straddle. So this box is actually my break even zone. And since my break even zone is beyond the support and the resistance, I prefer doing the short straddle. So in case, let us say, my break even was within this support and resistance, then I generally prefer doing the short strangle. So because in this particular case, the support and resistance is within the break evens, I prefer the short straddle. I am now more or less looking for Bank Nifty to breach the support or resistance. So let's quickly simulate and see when exactly I would be adjusting. So because it is within the zone of support and resistance, so there is no need to do any kind of adjustment. So, and I also know for a fact that if the support and resistance is breached in the beginning itself, my break even will be still far apart. So right over here, you can see what happened. So the market actually crossed 42,500, which I had marked as resistance. So one thing, we haven't still touched our break even, but we have broken the resistance, and that is the reason I will end up adjusting the trade. In simulator, let's quickly open 24th of April, 1 p.m. And once I do that, you can see right over here, we are at a profit of 1000 rupees, still not breached our break even, but the resistance is broken and I will end up adjusting my trade. So this is one time when I end up adjusting the trade. So we discussed about two things. One is support and resistance being broken and the other thing is premium. The second time when we actually adjust is when the premiums are mismatched. Before we look at the charts, let us first try to understand the concept. Let us say I have created a short straddle by shorting CE and PE at 300 rupees each. Now assuming the market goes up, this particular CE leg becomes 450 rupees and this particular PE leg becomes, let us say, 180 rupees. So this would make me holding this trade very uncomfortable because the premiums are quite mismatched, and the thing is, anytime if the market continues to go up, this 450 can go to 500, 600 and 700, whereas this 180 is not going to come down to zero. So maximum it can come down to is maybe something like 50, and beyond that it is going to come down very little, and this on the other hand will end up surging quite a lot. So that is the reason I do not like to hold any premiums which are more than double of the other. In simulator, I have randomly picked 19th of May. So let's simply create a short straddle at 43,900. The premiums are trading at 296 and 291. So now when I actually move ahead by 30 minutes, the premiums are 363 and 232. So I won't end up adjusting. So let's go even further. Now you can see the premiums are 449 and 182. So this is a situation which would actually make me uncomfortable to hold this puts. The reason is very simply because the puts can go up even further and the calls won't come down. So what I would rather do is cut this at 400 and simply add a put trading around 200. So you can see what exactly I ended up doing. I ended up balancing these premiums because there is imbalance. So we shorted this both around 300. This is at 182 and this had gone to 450. And that's the reason we had to balance the premium. So these two are one of the major reasons why I actually end up adjusting the trade. So the thing what you have to note here is when I am trading, it is not that one trade I will adjust based on support and resistance. The next trade I will adjust based on premiums. It is always either or. So either the support and resistance is breached or the premiums are imbalanced. So if one of this happens also, I will end up adjusting the trade. So it is not that I'll only look for one particular thing in a trade. So anything that happens in a trade, I will end up adjusting. So this is the main crux of when I end up adjusting a short straddle trade. So now we'll move on to the most important thing, that is how to adjust. So how do you end up adjusting a short straddle trade? The thing is, as I told you, there are multiple ways to adjust a short straddle trade. And in this particular video, we'll be sticking to a very simple one called as shift. So this is my favorite way to adjust any kind of short straddle or short strangle trade. So I'll be teaching you in detail how exactly you can use shift to adjust a short straddle trade based on what we have learned in the previous two. When I say shifting, it involves either pushing your call legs or put legs up or down. So you cut a trade and then you add another leg. So now let us say market is trading around 43,500. So you have a 44,000 CE and 43,000 PE. So you have created a short strangle, right? So now let us say the market starts to go up. So from 43,500 it goes to 43,700. So when you say shifting, you have two options. Either cut your C leg and push it away, so maybe to 44,200 or 44,300, or cut your P leg and bring it in closer. So you can cut your P and get it to something like 43,300. So in this, you have two options. So when the market is moving up, either pushing your C leg away or bringing your P leg closer in. So which one is the right option or which one would you choose really depends on the situation. Understand this better. Let me give you an example. Let us say there is India versus Pakistan cricket match. So it is a T20 match which is happening and Pakistan has scored 200 for 5 in its first innings. So the score is pretty good. Pakistan has scored 200. So now Pakistan has posted a very competitive total. But unfortunately, the Indian top order batsmen do not perform well. So India in the first 10 overs itself have a score of 80 for 5. So 10 overs are done, score is 80 for 5 and now Dhoni comes out. So on one hand, the required run rate is close to around 12 and there are no wickets, right? So how would Dhoni actually start batting? Would he try to stabilize the situation first by taking singles or will he try to hit 6 in the beginning itself? We all know that MS Dhoni is a very good striker. So he is known for hitting the ball out of the park. But it is really dependent on the situation how he is going to play the next 5 overs. So, most likely, judging the situation, Dhoni will not try to be aggressive till the 14th or 15th over. So, post which Dhoni will actually start to strike. Since the things are not under control, he won't try to be very aggressive in the beginning itself. So, that is how exactly we have to look at our trade. So, in the first example which we took, so let us say the market starts to go up, that is to 43,700. And whenever you shift away, so let's say you cut this call leg and start to shift away, right? So that time you're trying to be less aggressive. But instead of putting your calls away, if you bring puts closer, let's say you start bringing it to 43,200, then you're playing the game more aggressive. So if you play the game more aggressive, the idea is that you're going to take on more risk and the losses also can be higher. So how should you play a particular situation? So should you be defensive or should you be aggressive? So the answer to this depends on how well you're able to judge the market. Sometimes the market will be very volatile, trading in a broad range. So it will be going up, down, trading in a broad range, quite volatile. So in such cases, it is hard for us to judge where the market is really going. And in such cases, it is also important for us to know we have to be defensive. In some cases, we clearly know the direction, we clearly know the trend, and let's say the market breaks the resistance and slowly starts to head higher. So here we are very clear about the direction, and in such cases, we can play aggressive. Now let's take a practical example and try to put everything that we have learned in this video, starting from when exactly we are going to adjust. First, let's mark support and resistance, and then if there is any imbalance in premium, let's try to make some adjustments. So we will also try to analyze the market and see whether we want to make any aggressive adjustments or any defensive adjustments. So now let's quickly pick a random date on the simulator. Let's say I'll pick June 2nd, which is Friday. So right now we have come to June 2nd and let's start simulating from this particular point. One thing what you have to remember is we'll be using whatever lessons we have learned in the previous videos of the series. If you remember, in the very first video, we learned about a different perspective to short straddle. We learned how we can have a bullish short straddle or even a bearish short straddle. Then moving forward, we also discussed about position sizing and most importantly, the exit. So when exactly we end up exiting our trades. So now we'll be using everything that we have learned into seeing how exactly we can manage the entire short straddle trade. Most importantly, if you haven't watched the previous videos, I would recommend you to watch that first and later continue this particular part. So before we mark the support and resistance, let's go back to the first video. So first video, we discussed about having a different perspective. So here, when you actually look at it, in the previous few weeks, we know that the market had a fantastic rally. The FIIs are buying continuously. The global markets are all positive. So that's the reason there is very little chance of a weakness. So even if we are creating a short straddle, we can maybe create a mildly bullish short straddle. So this is considering the current perspectives or current things which is happening in the market. Overall, if I have to give an outlook, I am not very bearish on the market. But on the other hand, I also see that the market is struggling to go up. And this is a perfect opportunity for me to create a short straddle. I would create slightly bullish short straddle. Let's start by marking the support and resistance. So when I zoom out and take a look at the chart, so the first level which would come to my eye is 44,200, which is likely to act as a resistance. Very simply because you can see here the market had gapped up, taken support multiple times, broke this support, again this level became a resistance multiple times, and again the market came down. So 44,200 is surely going to be a very important resistance which I would be marking. Now coming to support. So when I zoom out and take a look at this chart, so I would mark my first support around 43,600, right? So why exactly am I marking 43,600? So you can see this part right over here. So initially the market faced some kind of resistance, came down. Again, once this was broken, it took multiple supports and went up. So that's the reason the support or the resistance that I would be marking would be 44,200 and 43,600. So let's start by simulating. So I would reduce the speed, and here I have changed to 2nd June 9:16. So let's see where the opening happens. So still the market has not yet opened, and the opening on 2nd June happens with a gap up around 44. 44,000. We have seen a gap up of close to around 200 points and moved closer to our resistance. So initially we had a plan of creating a bullish short straddle, but right now we will have to change our plan because the market has already opened higher and it is very close to the resistance. So because of which, let's end up creating 44,000 short straddle itself. So I have created a 44,000 short straddle and you can see my break even 43,400 and 44,585. So very close to where we have marked our support, but still the support is within the break even. So let's start simulating this particular thing. So the market starts to come down and let us try to see the premium. So right now the market has crashed to 43,840 around 10:20 p.m. You can see around 10:20 we have a profit of 130 rupees. The PE has gone to 348 and the CE has come to 231. But neither our support is breached nor the premiums are imbalanced enough for us to change. So let's just continue with our simulation. So at this particular point in time, so I would very well shift my support from 43,600 to 43,700. So let me also give you the reason why exactly I would do that, because multiple times I did see the market was taking support right over here around 43,848. So that's the reason, given that the market is finding support around this level itself, it does not make sense for me to keep my support level so low. So I can use this low as my initial support. So right after this low is breached, I will end up adjusting the trade. Or if this particular level is breached, I will end up adjusting the trade. So you can see I am changing or bringing closer my support and resistance also based on how the market is behaving. Right. So right over here on Monday, we ended up breaching this level of 44,200. So let's just go to Monday morning. So you can see around the time of 9:25, you can see two things that have happened. One, we have actually come to our resistance, which is 44,200, and also there is huge imbalance in the premium, right? So it is 132 and 382. So very obviously, I am not very comfortable with this particular position and I do not want to come closer with my puts. First, I am going to exit my call option and then push it away to 44,500. So right now I have pushed my call option to 44,500. It's trading at 132 and 118 and overall I have made a profit of 1,700 rupees as of now. So let's continue simulating. So you can see right at this particular point, right? So the market tried to go higher, but it faced resistance and immediately it came down and it was unable to hold this day's open. So it did try once. So you can see right over here. So we had opened with a gap up. The market tried to go higher. It faced resistance, came down, took support here, again went up, and again now it is well below the support line, right? So that's the reason I am going to go to that particular time, that is Tuesday around 10:40. So what I would do is slowly start going forward and see if we had got any other chance to adjust based on the premium. So as I move forward, you can see the premiums are more or less balanced. So let's move even further. So right in the morning itself, you can see that the premiums are slowly starting to get imbalanced. But let me just continue with the same premium, 60 and 116. So as I move forward, okay, at this point itself, I would have adjusted. So here it is around Tuesday around 10:40, but I wouldn't have waited till 10:40 because there is already big imbalance in my premium. So at this particular point, so when I look back at the charts, so I do see that the market was not able to break the high. So let me just move the resistance little higher, so to 260. So this is where it actually faced multiple resistances, right? Initially we had marked 200. So later we got to know that it is not breaking 260. So there is nothing wrong in changing the resistance, right? So now you can see the premiums are 49 and 128. So right now there is imbalance in the premium, but on the other hand, so I'm not really sure if the market is bearish right now or not. So if you see, it is trading somewhere close to the resistance itself. So it can anytime break the resistance and go up. So I'm not sure if I should go bearish. So that's the reason what I would do is move in my calls. So I'll slowly start moving in my calls to something trading around 73 or even 105, that is 44 400 or 44 300. So let me first start by moving into 44 400. So as we come to 1040, I told you this particular logic. We have now actually broken the day's opening and we are moving lower, because of which you can also see there is imbalance in the premium. So one premium is trading at 146, the other one is 64. So which gives me one more reason to end up shifting. So again, I will end up moving closer in with my calls. I'll exit this 44 400 calls and I will come in closer with my 44 200 calls. So right now you can see we have puts trading at 146 rupees, calls trading at 177 rupees, and let's continue our simulation. So the market comes down. So let's slowly start moving ahead with the chart. So the premiums are right now balanced. So there is no need to change any position. So the premiums are very close to each other. So again, I'm not going to do anything till this resistance is breached. One more thing is maybe we can slowly shift the resistance higher, because here is where we saw multiple rejections. So now let's take a look at level of 44 270. And like how we ended up shifting our support, we can also shift our resistance slowly. So let's also bring our support up to 43 800. So as soon as 43 800 is breached, we can end up adjusting our trade. So let's continue with the simulation. Again, the market ends up going higher. So you can see on Tuesday, Wednesday in the morning itself around 9:20. So there is no imbalance in premium. You can see 125 and 180 is something which I would be comfortable holding. So I wouldn't be adjusting in any of these situations. So I would be very comfortable holding this trade. So right over here, maybe around 315. So this would actually make me feel little uncomfortable, because 80 and 225. So there is huge imbalance, and obviously I cannot carry such a bearish trade for tomorrow, right? So this is a purely bearish trade because the puts are almost one third of calls. Again, at this particular point, I can either push my calls away or bring my puts closer, and I would choose to push my calls away. So why am I pushing my calls away? Because I'm uncomfortable with the situation. So I don't know from this particular point. So let's go back slightly, because we are trying to adjust right over here. So we are very close to the resistance, and I don't know from this particular point if the market can break the resistance or not. So let's end up shifting our calls. So you can see what exactly I'm doing. I'm not just looking at the market. Meanwhile, I'm also trading the premiums. So both are going hand in hand. So we saw two things. One, trading the markets based on support and resistance, and also trading the premiums. So I'm trying to do both. First, I'm trying to simulate the chart. see where the market is going. And meanwhile, when I look at the premiums, I'm also trying to see before the support and resistance is breached, was there any imbalance in the premium? So here we found imbalance in the premium. So now we have already simulated till Wednesday morning. So let's quickly go ahead by 30 minutes. And you can see 44,400 is right now at 87 and 44,000 PE is at 53. So I still wouldn't be changing my trades. So you can see Wednesday right at the opening, two things have happened. One, the premiums are now 50 and 94 because of the gap up, and because of the gap up we have also breached our resistance. So which means that we have to end up shifting again. At this particular point I would prefer shifting my calls farther away because I am not comfortable holding this particular trade. So I would shift to slightly bullish trade. So you can see the puts are at 50, the calls are at 35. So this is slightly bullish trade. So why exactly have I made it bullish? The answer is pretty simple, because the market has breached our resistance. So the markets can start to go up from here. So let's see where the market goes. Okay, unfortunately for us, the market ended up coming down. So let's quickly start moving and see if any adjustments were required. 49.30, 28.50, 21.68. So around 10.47, that is when the markets came down here. So we again had to adjust. But this time, again, I will end up bringing my calls closer. Close this at 21. Come in with my calls to 64. So we have a 68 rupee put and 64 rupee call, and we'll just continue simulation. So again at 9:45 we actually broke the day's high also of the previous day high. So before which we have already come to Thursday. So before which let's quickly go in time and take a look at if any adjustments were required or not based on the premium. So it's 63.60. Let's go even ahead. 28.53, 60.26, and the market is at 44,289. So Thursday morning it is at 60 and 26. So here I would bring my puts higher rather than pushing my calls away, right? So I would bring my puts closer from 44,000 all the way to 44,200, which is trading around 70 rupees. So we have 60 rupee and 70 rupee, and now the rally starts to come. The CE is at 74 and then the P is at 63. So no need of adjusting. And at this point, it is 102 and 55. And this is mostly this particular rally. So I would exit everything at this particular point. So I don't know where the market would go or where the market would end. So I would simply exit everything because I am uncomfortable holding the trade. So please watch the third video where I tell about when you can exit the trade if you're uncomfortable, right? So now it is already the expiry day and the premiums are low, and it no longer makes sense to keep on adjusting this trade. Rather, you can take a fresh trade on the expiry day. So overall you ended up making close to around 2.7% on the capital. So you can simply exit everything. Again, there is no point on adjusting this trade over and over again, because once you go to the expiry day, the premiums are very low and you might have to do multiple adjustments multiple times, right? So let's quickly take a look at where the market ended. Okay, so it so happened that we might have made the best profit, but at this particular point we were not comfortable holding the trade. So if we had just held it for some more time, we would have made the best profit. But it is more important to know when to exit the trade rather than have it, right? So in this particular video we just learned one basic adjustment, which is shift, and it also happens to be my favorite adjustment. We also saw in the practical trade how exactly you can end up using this adjustment of shift. Along with that, I also try to use some concept which we had learned from the first video and the third video, that is a different perspective, and also about exiting short straddles. In this particular trade, to give a detailed perspective. This was just one simulation. You can also end up simulating using the Stockmock simulator. Practice these adjustments before you try out in the real trade, and once you are comfortable, you can start by deploying just one single lot. Just deploy one single lot, and maybe slowly you can increase the lot size. So always remember, it is not one thing which makes you the profit, it is multiple things together which actually helps you make the profit. That is one, the right entry, two, judging the market the right way, and most importantly, the exit. So here I try to cover or give a complete perspective using everything that we have learned, and I also hope you found this video informative. If yes, then do not forget to hit the like button, share this video, and also subscribe to my channel. And you can also check out quickalpha.in for more services. Thank you so much for joining.